Hey everyone, and welcome to this explainer. I am so incredibly glad you're here because today we're tackling an absolutely massive, pivotal shift in the corporate financial world. We are talking about Singapore's new Multinational Enterprise Act, or the MMTA for short. Look, if you're a tax professional, a financial controller, or a corporate strategist, this is your new reality. Now, I know at first glance it can feel like this dense, totally impenetrable regulatory maze. But hey, that is exactly why we're here. We're going to break it all down, cut straight through the noise, and give you the exact, absolutely crucial compliance essentials you need to get ready for the global minimum tax right here in Singapore. So let's dive right into this, shall we?
Here is our game plan for today. First, we'll look at the global minimum tax. Second, Singapore's new rules. Third, we'll answer the big question, are you in scope? And finally, we'll wrap up by navigating safe harbors.
All right, let's jump straight into part one, the global minimum tax.
So to really grasp this massive global shift, which is basically designed to stop tax base erosion in its tracks, we have to look at the OECD's BEPS 2.0 initiative. It's split up into two main pillars, Pillar 1 and Pillar 2. But for our purposes today, our focus is squarely on Pillar 2. That is, the global minimum tax. Now, pay close attention to the two main engines running Pillar 2, the Income Inclusion Rule, or IIR, and the Qualified Domestic Minimum Top-up Tax, which is a mouthful, so we just call it the QDMTT. These are the foundational concepts you really need to wrap your head around. The core idea here, it's simple. It's to ensure that these giant multinational enterprises are paying a baseline minimum level of tax on the income they make literally anywhere in the world they operate.
Moving right along to part two, Singapore's new rules. Okay, so now that we've got the global context down, let's look at how this lands right here at home for any financial year starting on or after January 1st, 2025. Now, if you've been reading through those dense OECD documents, you're probably suffering from some serious jargon fatigue right about now. So let's act as a bit of a translation guide. In Singapore's localized rules under the MMTA, that Global Income Inclusion Rule, the IIR, is actually referred to as the Multinational Enterprise Top-up Tax, or MTT. And similarly, that global QDMTT we just talked about, locally that translates to the Domestic Top-up Tax, or DTT. So basically, whenever you hear MTT or DTT in a Singapore context, just know they're simply the locally enacted versions of those global Pillar 2 standards. It's the same core stuff, just with a local label. To actually make complying with all this manageable, the Inland Revenue Authority of Singapore has laid out a super structured, highly mechanical 5-step blueprint. Let's walk through it together. Step 1 is simply figuring out if your MNE group is even in scope to begin with. If you are, you move to Step 2, which is identifying the location of all your constituent entities, or CEs. Step 3 is where you eagerly check if you qualify for any safe harbors to maybe ease some of that compliance burden. Step 4, well, that's the heavy lifting, computing the globe income and covered taxes. And finally, Step 5 is calculating the jurisdictional effective tax rate, your ETR, and figuring out the actual top-up amount you owe. Keep this exact blueprint in your mind because it is literally the best way to compartmentalize your whole compliance strategy.
Which brings us to part 3, are you in scope?
Honestly, this is the most critical question every single tax professional needs answered right now. Is my enterprise actually caught in this new regulatory net? Well, here is your answer. 715 million euros. Seriously, burn this number into your memory. This is the magic consolidated revenue threshold. If your group's consolidated revenue meets or exceeds that massive number, boom, the compliance requirements under the MTA are officially triggered. But as we're about to see, applying this threshold isn't quite as simple as just glancing at last year's tax return. Actually, before we even start crunching the numbers, we have to define exactly who we are talking about, because these rules strictly apply to a multinational enterprise group. So what exactly defines an M&E group? Well, it's a group that has at least one entity or a permanent establishment located completely outside the jurisdiction of its ultimate parent entity. So the really crucial takeaway here is this. If you're a wholly domestic group, meaning all your members and operations are strictly contained within one single jurisdiction, you are exempt. You don't even count as an M&E group under these rules. Let's make this totally concrete. Think of a standard corporate organizational chart. You've got different subsidiaries scattered across various jurisdictions, right? But they all eventually link back up to that one top box, the ultimate parent entity, or UPE. Because that UPE in, say, jurisdiction A, has subsidiary branches reaching out into jurisdictions B, C, D, and E, it definitively qualifies as a multinational enterprise group. And here is the kicker.
The financial foundation for every single one of our MMTA tests relies entirely on the consolidated financial statements that are drawn up right there at that top box, the UPE level. Okay, remember a minute ago when I said applying that 750 million euro threshold wasn't super simple? Here is exactly why. You don't just get to look at the current year's revenue. Nope. You are flagged as in scope if your consolidated revenue hits that threshold in at least 2 out of the 4 preceding financial years. So imagine we are testing the financial year 2025. You have to look backwards at 2021, 2022, 2023, and 2024. If your revenue hit, say, 800 million in 2022 and 850 million in 2024, well, that's 2 years out of the last 4 where you crossed the 750 million line. Therefore, for 2025, you are firmly in scope. This look-back mechanism is basically a trap designed to prevent massive companies from slipping out of the compliance net just because they had a temporary 1-year dip in revenue. All right, let's put this into practice. I've got a bit of a challenge for you to see how these scope rules actually apply in the real world. Let's imagine a really wealthy commodity trader. We'll call him Mr. A. He directly owns 100% of 3 completely separate corporate entities, and they are all in different jurisdictions. Combined, the revenue of these 3 companies easily blows past that 750 million euro mark. So, what do you think? Are they considered an in-scope M&E group? Let's break down his exact setup to find out. Mr. A owns Company S in Singapore, Company Y over in Jurisdiction Y, and Company Z in Jurisdiction Z. And to make it interesting, let's say Companies S, Y, and Z all own other smaller entities globally. Now, Company S consolidates all of its subsidiaries. Company Y does the exact same thing. But here's the massive twist. They consolidate completely independently of one another. They never roll up into one single master consolidated financial statement. Why? Because Mr. A is just an individual person, not a master parent corporation consolidating them all at the top. And that, my friends, leads us to the absolutely crucial punchline. Consolidation is literally everything here. The MMTA threshold is strictly 100% determined by reference to the consolidated group revenue reflected in the ultimate parent entity's financial statements. You can't just mash together the revenue of separately owned entities to hit that 750 million euro mark. Because Mr. A's 3 companies don't consolidate together into one single UPE statement, they are evaluated as totally separate groups. So unless one of those separate subgroups independently hits the threshold on its own, they are completely off the hook. They are not caught in the MMTA net. All right, moving to our final section, part 4, navigating safe harbors. Now, if you've run all these tests and realized, oh wow, our enterprise is definitely in scope, go ahead and take a deep breath. The authorities actually know this is incredibly complex, so they've thrown us a much-needed short-term lifeline. It's called the transitional CBCR safe harbor. To qualify, you basically have to meet some specific metrics based on your country-by-country reporting. For instance, you could pass the de minimis test if your total revenue in a given jurisdiction is under 10 million euros and your pre-tax profit is under 1 million. Or, alternatively, you could pass the simplified ETR test if your tax expense divided by your pre-tax profit hits at least 16%. But listen up, because this is vital. You absolutely must elect to use this safe harbor in your very first eligible year. It is a strict use it or lose it scenario. If you skip it in year 1, you are completely locked out of it for all subsequent years. No exceptions. Well, we have covered a tremendous amount of ground today, right? From the whole global BEPS 2.0 framework all the way down to the exact nitty-gritty mathematical tests of Singapore's new MMTA. Before we wrap up, I want to leave you with a provocative thought to take back to your teams. These rules take effect for financial years starting January 2025. So you need to ask yourself right now, is your internal financial data actually properly consolidated? Is it rigorously categorized across all your jurisdictions? And is your team absolutely ready for this new tax reality? Because the clock is ticking and preparation is quite literally everything. Thanks so much for hanging out with me on this explainer. Keep learning, keep preparing, and I will see you next time.